Welcome to Integrated Insights with ICCG. For more than 30 years, our team has partnered with small business owners to prepare for and navigate the business transaction process. Pull up a chair as we share stories and insights from our experience on all sides of the M&A table. All right, and welcome back. My name is Michael. I'll be your host today. I'm joined by Grant and Andrew. Today, we're going to be talking about working capital in action. So if you missed our last episode, we talked all about what is working capital and working capital in a business. Today, we're going to focus on it within the business transaction. So Grant, Andrew, when in the business transaction do we start the working capital conversation?
It's very early. When we cover it with our clients, it's very early on. The reason is just because we want to set the tone. We want to set the expectation of what's going to happen. And it does go into the net calculation for what you're going to walk away with at the end of the day. And so, and I know we'll get into that in a little bit, but at the end of the day, as a seller, you are concerned with what you're going to walk away with at the end of the day, not the total purchase price. I mean, there's probably some, hey, I want to go brag at the country club, but at the end of the day, they are more concerned about what they're going to walk away with, and the working capital does affect that. And so we'll kind of walk through that with them pretty early on before we start marketing the company. And so and that way we can also have them know what to expect when they start receiving an offer. They know a little bit more of what they can expect to when reading the offer and when we go over the offer with them.
Yeah, I would just add to one of the unique things that we do for clients is actually before we even sign up them as a client, because we want to. I mean, we can assign a ton of clients up, and they think they're going to get $100 million for their company, and we know it's not worth 50. And so why would we sign them up to an exclusive representation to sell their company? Because we can't accomplish their goals. So when we take them an offer for $50 million and they thinking, well, I'm not going to take that. Well, it might be what the market says their business is worth, but their expectations are not fulfilled. And I kind of used a little bit of a hyperbole there, but I think it goes down to that net number. We want our client to understand that the value that we anticipate is going to yield a net that they can accept. And part of that net includes excess working capital or maybe a deficiency in working capital they got to leave in the company. And so we've got to include that almost before we even accept the assignment. So it starts really early. I'm not sure that our clients understand the way it works until later on in the process when we actually go through like a what if it closed this month, here's the way it would end up. And then the more and more we do that, the more and more they understand, oh, that's how it works. And then they understand the purpose of doing it the way we do it in the transaction.
That's great. So talk about that a little bit more, because some people might be hearing working capital and think that it's a flat number, that's what they're going to get because that's what they need to run the business. So how does timing and where a company is at a specific time affect what working capital will be at the time of close?
Yeah, so let's just talk about how, the biggest, let's just say you got a seller that is one of our clients and they just think they're going to work the system. And so what they do is they go out there and they stop paying their bills. And then they hurry up on their collections. They just hard collect on all the clients. And they just tickle pink because it's a cashless purchase and they've got all this cash in the bank. And the buyer comes in and he's got all these bills he has to pay and he's got no accounts receivable to collect. So he has to put more money into the company in order to operate the company. So he thinks he's going to work the system. Correspondingly, the buyer, the buyer is protected because the seller is on the same page as the buyer. So the seller is not going to hard collect on clients. So his customers are going to be okay. He's not going to stop paying vendors. So the vendor relationships are going to be fine. And so it protects the business. And so the reason why we do this working capital process that we use is really to protect both parties. It's not, and I've said this to you guys all the time, a ton. It's not a let's get one over on the other side scenario. It is what is fair, and it's a win-win. So you protect both parties so that the business can operate in the way that both the buyer and seller anticipate.
So does the working capital amount affect the sales price, or are they exclusive?
No, the net working capital, which a lot of people call the working capital peg, is what we all agree on is what comes with the purchase price. And so let's just talk about that for just a minute. If I spend $10 million buying a company, and I have to immediately put $2 million into the bank in order to pay payroll, in order to buy inventory, in order to pay off bills, those kinds of things, then I really didn't pay $10 million for the company. I paid 12, right? And so when I pay $10 million for the company, I want sufficient working capital, meaning accounts receivable, inventory in the company, in order for the company to go on operating without me having to put additional $2 million in the company, right? Because I valued the company at $10 million. And so there's an amount that is appropriate, let's just say, for the company to keep on running without me having to invest more money into that company. And we help calculate that. And so just, maybe there's a little bit of a soapbox here for me. But a lot of times these buyers will hire an audit firm or some sort of a test firm that will do a quality of earnings. And they will judge working capital based on what it always has been. In other words, an average of what you have had in the company over the last 2 years. Well, most of our clients have excess working capital in there. They leave money in the bank, and they just don't worry about taking everything they can out of the company because they don't want to have to manage cash flow that tightly. And so the idea is to determine exactly what is necessary. And we have, it's not our way, but it's a common way, but it's not commonly used by people that like us. And that is the way to determine how much working capital you need for the company to generate itself. It's kind of like pushing a wheel, and then as the wheel turns, it kind of generates speed as it goes, right? So that initial push, how much working capital needs to be in the company in order to get the cash generating revenue model to start rolling. And so we help calculate that. It's a point of negotiation. It's a peg. It's a number that has to be in the company when we pay a certain amount for that company. And when we do close, and there's more accounts receivable, let's say, because they just made a big sale, that accounts receivable, it really belongs to the seller. And so there's an excess of working capital at the time. If, for example, all of a sudden there's all these receipts that come in the door, now there's very little accounts receivable, so they may not be enough in the company, and so the seller needs to leave cash in the company so that the buyer can continue paying payroll and buying inventory. And so the number, it is a number, a net number that you agree on, you negotiate for, but it determines how you reconcile closing. And if it's excess, the seller gets more. If it's a deficit, the seller gets less.
Can you talk about a holdback a little bit there? It kind of transitions right into the same conversation, but how is a holdback used in deals related to working capital?
I'll explain, because I know we recently just had to kind of deal with that a little bit in a recent deal, because we didn't have a holdback. We represented the buy side, and the reason why we need to do a holdback is because it's really for the working capital true-up period. And I know there are other reasons for indemnification, like an indemnity bucket, all those kind of stuff that we can talk at another time. But for purpose of working capital, there's got to be some sort of true-up period, right? We can say that, hey, we can say that okay, it's going to be, round number $100,000, and as a working capital peg, but we need time to kind of prove that that's the actual number, right? Because it can be a moving target. There can be other things that the seller didn't include in the calculation, and so there needs to be that time for a true up period, so that maybe 60 days, 90 days later after closing, we can kind of say, okay, that's when there's hey, we can confirm that it is 100,000, or maybe it's 110, maybe it's 80, maybe whatever that, it's a moving target. So whatever that number it lands on at that time, then that's it. Now, I mean, there's going to be an agreement, right? Before, I guess the peg is not the one that's moving. It's really working capital at closing is what's going to move. And so at closing, the seller delivers a working capital calculation, and they will say, okay, it's the peg was 100,000. I've got 120,000, or I've got 150,000. And so that true up period is, okay, what was actual in that working capital closing? The buyer does its due diligence then, and then at that time, okay, we can confirm that it was 150,000. Here's your extra 50,000. And so, or hey, nope, that was wrong. It was actually 90,000. And so, maybe there's a switch there. So really, it protects both sides. So that there's a period of time where the due diligence can be done.
Yeah, and so we got to be careful that we don't confuse mixing the two concepts of holdbacks and working capital true up, because it is a way that they can satisfy a deficit, but it's not part of the working capital. In other words, if I agree to pay, if I'm going to buy your house, for example, and but I've never seen it because I live in a different country, and I'm going to pay you, $1 million now, and then once you move out, I'm going to give you another 200,000, right? And by the way, you may not have paid the utility bill. You might not have, you might have left a big hole in the ground instead of a toilet. And so I'm going to use that $200,000 to fix those things, because I'm paying $1.2 million for your house, right? A business purchase is very similar to that. Is that in a holdback is I'm going to pay you $1.2 million for your business, but I'm going to hold back $200,000 in case you owe me money, because I can't go get that money from you without incurring legal fees and all kinds of stuff. And if I determine that I don't owe you any money, then I'll pay you the $200,000. And so sometimes those holdbacks are, for a year, sometimes 2 years. And it's generally less than 20% of the purchase price. But that's a holdback. And the reason why it kind of goes to along with some of the settlement of the working capital settlement, or the true up, as Andrew said, is only because if the seller owes the buyer money, then they just reduce the holdback. Or sorry, if the buyer owes the seller money, they just reduce the holdback.
So now some of our listeners might be thinking, hey, my business is changing all the time, right? I could get a new deal, a new big order any minute. How is working capital, how is that calculation going to be ready for that, right? So what happens, Grant, earlier you were talking about a company could receive a $2 million order from Target at any time. And so what happens in that situation when a deal is already occurring in process and a big change happens like that?
Yeah, and this happened with one of our clients who was dealing with SpaceX, and he got a huge order and finished the order off in between cutting a deal and closing. And so we had to go to the buyer and say, hey, you're going to have an additional $2 million when you come to the table. And he goes, well, that's ridiculous. I mean, the value of the company hasn't changed just because you got a big order. And we said, well, our accounts receivable is $2 million more than the peg. And so you're gonna have to bring that to the table. And so what we did is we negotiated a way where the buyer could pay that $2 million as he received the money from the big client. And so, there are always these kinds of changes in the business, but, as Dave always says, bad news doesn't get any better with age. We try to make sure that we keep both the buyer and the seller abreast of what's going on so that the buyer knows what he's going to have to bring to the table. And we can negotiate and make sure that if he needs additional time to pay that additional amount, if it's reasonable, we'll talk to our client about, accepting those terms. But it is something that, the business does change. The whole idea is that the buyer is not cheated and the seller's not cheated.
So you just said the buyer is not cheated, the seller's not cheated, and that's great. Like, we don't want anyone to take advantage of anything during the selling process, during the business transaction, negotiations, any of that. What happens after the deal closes? How does working capital help to protect the buyer and the seller after the deal closes?
Yeah. So, remember, there's at least this is the way we try to script it. Other people handle it differently. We just try to make it as smooth as possible. No surprises, right? That's what we try to do. And so we have previously negotiated that the working capital is a certain amount. Sometimes at closing, we won't settle anything on working capital. Sometimes we say the seller is going to estimate what those actual balances are and say, hey, I've got an excess of $100,000. And the buyer then has to bring that $100,000 to the table at closing. But the buyer then has 60 days or sometimes 90 days, depending on the complexity of the accounting process, to determine what it actually is. And then there is what is commonly called a true up. In other words, he determines, like after auditing it, what exactly that really was. So if I'm the seller and I didn't include a big bill that I owed, then he can include that in his calculation. And then they figure out who owes who, what, and then there's a true up. And if the seller owes the buyer some money or the buyer owes the seller some money, that's when it happens. And there's I'm not going to say, I nearly said a wasted 2 pages of a legal document, but there's a very complex process that lawyers put together of, okay, what happens if we don't agree? Right? Okay, we can get a mediator. We're going to hire an accounting firm to do this and all that kind of stuff. Well, we generally try to mitigate that by stepping in because we've been dealing with both parties. We know the company really well. And so we'll try to make them agree before it goes into some sort of arbitration or something like that. But if we've done our job right, we've really helped our clients understand what the pieces and parts of that working capital are, and they understand the merits of it. They may not agree on everything, but one of the things, I'll give you an example. Most people don't think about the accrued liability for PTO. Well, just imagine going into a company, buying a company in October, and none of the employees have taken vacation. And you owe all of them 2 or 3 weeks worth of vacation. Well, what am I supposed to do with that? If they all of a sudden all took vacation in the last 3 months out of the year, then I don't have any. I've got to pay them, and I have to buy help. I have to buy temporary help to fill all the desks, right? Or if it's a retail place, and so it's the same thing. It's like we always ahead of time we say, hey, there is a liability that you don't normally put on your balance sheet, and it's called accrued PTO. So let's try to calculate that so we can prepare you, because once they calculate working capital, they're going to include that in the working capital calculation. So don't be surprised. And now we can argue whether that includes payroll taxes or whether that includes this and this. It's a minuscule amount. The idea is we prepare our clients so that there are no surprises. We can agree on what it is. And, if you incurred the bill, then you got to pay the bill. If you didn't incur the bill, you don't have to pay the bill. And so it's not quite a science, but if you prepare your clients ahead of time, as well as the other side, it's a very smooth process. But yes, we do work with our clients after closing to make sure their interests are guarded.
So I know we have tons of stories from more than 30 years of doing this. So are there any other stories that come to mind of just where working capital played into our impact on how we were able to help a client through a business transaction?
Yeah, I feel like that's the way that we help our clients is taking a lot of that conversation, because it's the conversation has to happen about working capital. And if you don't understand it, it's really hard to negotiate it, because it is another point of negotiation. And so we have to take that on and make sure that and to be honest, a lot of our clients just won't understand it, because I think you joke, but it might be serious that you explain to a client maybe 25 times what working capital is, and I know I've done the same thing, but at the end of the day, if they trust, they need to trust us, right? And we're going to make sure that they're taken care of, and so we take care of them by taking that conversation, and we negotiate for them what that work capital peg is, the script of how it's going to be paid, the script of just how to write it in the purchase agreement. And because at the end of the day, if we don't help them with that, sellers can be taken advantage of. And so much like Grant said earlier, is that sellers might try to take advantage of the system, and then it's a big surprise later. And so we have to and we help them by saying, hey, don't do that, because it's going to hurt you in the long run, because you're going to be surprised that, oh, you've collected so much and not not paid any of your bills, and so you're gonna have to owe, and it's just a surprise for them, and we just have to we serve them by taking that conversation on, and so it can be a difficult one, and it is working capital itself and that negotiation can be a deal killer, just because it's a almost like a convoluted conversation, right?
Yeah, and how many times you talk about deal killer? A lot of deals are killed because a seller doesn't understand and they don't want to understand, and it becomes, at this point, there's a lot of fatigue, and if you don't deal with it up front, then all of a sudden there's some really important things. And so, expectations are super important to meet. And so how many times have we, talked to a seller and the seller goes, no, the accounts receivable is mine. I earned it. Oh, I earned it, right? I'll pay all the bills, but the accounts receivable is mine. Okay, so let's just walk through the consequences of that, right? So you're going to keep the accounts receivable. I'm buying your company. You're going to hard collect on my clients. Why would I want to buy a business and you still have control over the clients? There's no way. And correspondingly, if I collect the accounts receivable and I have to pay it to you, I'm going to give them all discounts on your invoices while I collect 100% of my own invoices, right? And so it just, we have to remove the possibility of mistrust and make it fair and meet expectations. And so when we talk about, we talk about expectations with our clients on a sell side, we're making sure they understand exactly what levers they can pull to move the sales price up and down, and what layers they cannot pull, levers. And so it's all about meeting expectations, and working capital is hard to understand. And so expectations are difficult to convey. And that's why we end up going, okay, you're going to get, this much net. And it's more than the sales price because of the way you've operated your business. And this is how it's going to get paid. And that's how we deal with working capital.
Well, repetition is important, right? So if this being the first subject that we've done 2 episodes on shows you anything, it's that we're trying to communicate that working capital is important. If you've been tracking with us so far, you can see now that how much we've talked about trends and consistency, and how important working capital is in both your business and the business transaction conversation. So if you're still thinking like, hey, you've given a lot of great examples, guys, and but none of those really sound like my business, we'd love to sit down with you. And we'd love to sit down and talk and help you to know what that looks like in your business, and what that looks like as you try to decide if it's time for you to prepare for a sale yourself. So make sure to send us an email. Grant, Andrew, thanks for joining me today. That's all the time we got. And that wraps up another episode of Integrated Insights with ICCG. Be sure to subscribe and stay tuned for more stories from our team. We love hearing from our listeners. If you have any questions or topics you'd like us to cover, please send us an email in the show notes. For more information about ICCG, please check us out on our website or follow us on LinkedIn and YouTube. Until next time, there's always a seat at our table.